Let me ask you a hard question before we go any further. Are you actually trading, or are you just paying tuition to a market that never asked you to enroll? Sit with that for a second, because most people who open a trading account are not investors, and they are not traders either. They are students in a school they never signed up for, paying fees they don't even realize they're being charged. And the market, unlike any school you attended, never tells you when the semester ends. It just keeps billing you, month after month, until your account hits zero and you walk away calling it bad luck. Here's the truth. Trading can make you rich. I've seen it happen, I've done it myself. But it only happens when you stop treating the market like a casino and start running it like a business. Everything else, every clever entry, every hot tip, every strategy you found last week, means nothing if the foundation underneath it is gambling dressed up in a suit. So let's talk about what's actually happening when you lose money in this game. Because I promise you, it's rarely the market's fault. Think about the last time you took a trade because someone online said it was about to explode. Think about the last time you doubled your position size after a loss just to get your money back faster. Think about the last time you closed a winning trade in fear, then watched it run another 20% without you. That's not trading. That's gambling with extra steps. Here is where most traders quietly blow up, and it's not in one dramatic moment. It's slow. It's a few $100s here, a few hundred there, a blown stop loss you swore you'd honor, a revenge trade after a bad morning. None of it feels catastrophic in the moment, but add it up over a year and you'll find you've paid the market a small fortune in tuition, and you have nothing to show for the lesson except a lighter account and a bruised ego. Let me ask you something else. Have you ever changed your entire strategy in a single week because it stopped working for 3 days? If so, you don't have a strategy, you have a mood, and moods are expensive teachers. Now, I want to be fair here, because not all losses are wasted money. There's a difference between necessary tuition and avoidable tuition. Necessary tuition is what you pay when you test a real idea, size it properly, and it simply doesn't work out that time. That's the cost of doing business. No different than a shop owner buying inventory that doesn't sell as fast as expected. Avoidable tuition is what you pay when you have no plan at all, when you're reacting instead of executing, when ego decides your position size instead of math. One of these costs builds skill. The other just drains your account while you tell yourself a comforting story about experience. This is the difference between a gambler and a professional, and it's worth saying clearly. A gambler feels every loss as a wound and every win as a high. Their emotional state rises and falls with each trade, like a fever chart. A professional feels almost nothing when a loss happens because they expected some losses to happen. They built the loss into their plan before they ever placed the trade. It's not personal. It's operational. Imagine running a small retail shop. You know a certain percentage of your inventory will spoil, get damaged, or go unsold. You don't quit the business every time that happens. You price it into your operations from day one. Trading works exactly the same way. Your positions are inventory, your capital is working capital, your risk is shrinkage. And if you don't control it with strict rules, it will quietly eat every dollar you have. Here's a question worth sitting with. If you ran a business where you didn't know your maximum possible loss on any given day, would you call yourself a business owner, or would you call yourself reckless? Most people in the market today are the second kind, and the market is more unforgiving of that than it's ever been. Decades ago, you could get away with trading on gut feeling and a decent memory for chart patterns. That world is gone. Today, you're competing against systems that execute in microseconds, against algorithms with no emotion and no fatigue, against data-driven operations that never revenge trade and never get greedy. If your only edge is a feeling in your stomach, or a tip from someone in a group chat, you are not in a fair fight. You are the house's favorite kind of customer. This is why a defined edge, real risk protocols, and a structured plan aren't optional extras anymore. They are the minimum cost of entry just to survive long enough to get good. Let's talk about the feeling itself, because this is where most people get honest with themselves for the first time. There's a rush that comes from a lucky trade landing right. Your heart rate climbs, your chest tightens a little, and for a moment you feel like you've cracked the code. That feeling is real, but it's not skill, it's dopamine. And dopamine is a terrible business partner, because it will push you to chase that same high again and again, regardless of whether the setup actually justifies the trade. Compare that to the feeling a professional has after closing a well-executed trade, win or lose. It's quieter. It's closer to satisfaction than euphoria. It comes from knowing you followed your process, sized your risk correctly, and let the outcome be whatever it was going to be. That calm feeling doesn't sell as many advertisements or get shared in trading forums, but it's the only feeling that survives 10 years in this business. Let me tell you about a trader I watched go through this exact transition because I think you'll recognize pieces of yourself in him. He started with a modest account and a lot of confidence. He'd win a few trades, feel invincible, and gradually creep his position size up. Then he'd hit a losing streak, panic, and start revenge trading to recover the losses fast. He'd blow up the account, fund it again, and repeat the entire cycle 3 more times over 2 years. Each time he called it a learning experience. In reality, he was learning nothing, because nothing about his process ever changed. He was simply paying the same tuition bill over and over, semester after semester, and failing the same class. What finally changed him wasn't a bigger win, it was exhaustion. He got tired of the emotional whiplash, so he sat down and, for the first time, wrote out an actual plan. A defined edge he could explain in one sentence, a maximum risk per trade, a maximum loss per day where he simply stopped, no matter what. A journal where he recorded every trade and reviewed it weekly. It wasn't exciting, it was almost boring. But 6 months later, his account was growing steadily for the first time in his life, and he wasn't feeling anxious every time he opened his screen. He'd made the shift from gambler to business owner. That shift is available to you too, and it starts with a few concrete pieces, the same ones any real business runs on. First, your edge. This is simply the specific condition or pattern that gives you a statistical advantage over time. It doesn't need to be complicated. It needs to be clear enough that you could explain it to someone else in 1 or 2 sentences. Second, your risk. Decide in advance the maximum you're willing to lose on any single trade, and the maximum you're willing to lose in any single day. Imagine risking only a small fixed slice of your account on each trade so that even a string of losses can't do serious damage. This single decision alone will save more traders than any strategy ever will. Third, your size. Once you know your risk limit, your position size becomes math, not emotion. You're no longer guessing how much to buy or sell. You're calculating it based on your risk rule and the distance to your stop. Fourth, your inventory. How many positions will you hold at once? How correlated are they? A shop owner doesn't stock all one item and hope for the best. Diversify your exposure enough that one bad trade or one bad sector doesn't wipe out your week. Fifth, your process. What do you do before the trading day starts? What do you do during it? What do you do after it closes? A professional's day has structure. A gambler's day has impulse. Sixth, your review. Keep a journal. Track your trades, your reasoning, your outcomes. Look for patterns in your own behavior, not just in the market. Most traders skip this step, and it's precisely why they keep repeating the same expensive mistakes without ever noticing the pattern. None of these 6 pieces are complicated on their own. What's hard is the discipline to follow them when fear or greed is whispering in your ear to do something else. That whisper is loudest right after a big win, when you feel invincible, and right after a big loss, when you feel desperate. Both moments will test whether you actually have a business or just a hobby with a bank account attached. So let's come back to the question I opened with. Can trading make you rich, or are you just wasting your money? The honest answer is both are true, depending entirely on what you decide to do starting today. Trading can absolutely build real, lasting wealth, but only for the person who treats it as a business. That means accepting losses as operating costs, not personal failures. It means building a defined edge and following your risk rules, even when it's uncomfortable. It means chasing consistency of process, instead of chasing the next dopamine hit from a lucky trade. If you refuse to do that, if you keep trading on impulse, keep changing your strategy every time it has a bad week, keep sizing your positions based on how you feel instead of what your plan says, then you are simply paying market tuition. And the market is a patient teacher. It will let you pay that tuition for months, sometimes years, before it finally takes the last of what you have and sends you home. So here's your assignment, and it's simple enough to start today. Write down one edge hypothesis, one specific pattern or condition you believe gives you an advantage. Write down one risk rule, the maximum you'll lose on any single trade, expressed as a small fixed percentage of your account, and commit to one rule you will not break, no matter how you feel in the moment. That's it. That's the beginning of a real trading business. Do this consistently, review it honestly, and adjust based on data instead of emotion, and give it real time, not a month, years. If you commit to that process the way a business owner commits to their craft, the market will eventually pay you what it owes everyone who refuses to gamble and insists on operating with discipline. That outcome isn't guaranteed to be fast, but it is available to anyone willing to do the unglamorous work most people avoid. The choice in front of you right now is the only one that matters. Keep gambling and keep paying tuition, or start today as the owner of a real trading business. The market doesn't care which one you choose, but you will.